They went viral with this post in 2019. It catapulted financial blog The Woke Salaryman to instant fame, with millennials looking to grow their wealth, with advice on finance and investments, as well as how to navigate adult life. These days, a sizable chunk of their audience is even younger.
I think they're around like 30%. Yeah, around 30% of audience, which is quite large. I think many Gen Zs have started investing a lot earlier than millennials. The Gen Zs spend their 20s in a pandemic where there was very little that they could do outside, very little social interaction. So we've seen like a lot of people get into the whole investing, the whole finance space since then.
So if I buy this one ETF, just one, every single month, I'll become a millionaire.
In 3 years, I was able to take my investments from about $10,000.
Tiger Brokers says its Singapore business saw a 90% year-on-year jump in account openings by Gen Z investors last year, those born after 1997. They've been spurred in part by lower barriers to entry online and the rise of advice in bite-sized chunks, perfect for a generation that's grown up on social media.
When we first started working, I remember you had to go and talk to a broker and ask a broker to actually buy the thing for you. And then in our time, digitization started to happen so that you could buy online. And then nowadays with cryptos and NFT, like I don't even talk about NFTs, but with cryptos, like, it's so easy and so quick to transact, and the market is online like 24/7.
National University of Singapore undergraduate Marcus Tan began when he was just 19.
I got interested by pure chance. So my mom was investing in the stock market then. When I was younger, I think I was 17, and she lost money. And that was when I realized, if somebody is losing money on one side, I think somebody else is, making money on the other side.
Now 24, he says he isn't afraid of volatility.
I think I can speak for quite a bit of my peers is that because we're a bit younger, so we do have a longer time horizon. And so we tend to look for a bit more, the stocks which are a bit more volatile, and of course higher growth stocks. So that's a bit risky, but of course, if we have quite a bit of timeline, we have the stomach to kind of, we have the appetite to stomach the risk, so that is okay.
While Marcus prefers looking at growth sectors, experts warn that many other less savvy first-time investors can be swayed by promises of making big bucks too quick.
There are tons of investment options out there now, right? I think in Singapore alone, we're looking at probably 40, 50 brokers, 40, 50 crypto exchanges to choose from, a couple of robo-advisors, insurance agents, wealth platforms, fund platforms, etc. And everyone is trying to take your money, or everyone is saying that they know what to do with your money. So younger investors, depending on how interested they are in the space, they kind of jump into whatever their friends are doing or whatever their colleague is doing, and perhaps not looking deeply into it enough to make that rational decision.
The hype around new investment opportunities can create unrealistic expectations.
Like I try to tell young people, some of the more like alpha investor type, right, about returns of say like 8 to 10%, and they would scoff at it. It's nothing to them because they are so used to baseline investment returns of like 20% at least. So the baselines are very different.
Speculative investments are very attractive for people to jump into because we always hear about the friend who made a lot of money and they just did this. They just did that. And in the trading of anything, that is possible, but it's not sustainable.
That sparked a debate about just how to reach out to this group, who, together with millennials, will inherit trillions in wealth over the next few decades.
it's a bit of an unfair playing field. The randoms online can say whatever they want and not be held accountable for the most part, right? And then those messages can really spread like wildfire as well. I think the traditional finance industry is very sort of, needs to comply with a lot of regulation. And everything, I mean, you always see everything with a lot of caveats. And that's just the way they have to communicate to protect themselves. I mean, it's reasonable, but it's very difficult to convey that short, snappy, like, buy this and it's going to go to the moon kind of message, right?
Is it even possible for these large corporations to change like in such a small span of time? Because like what made them appeal to the older generations might not, I mean, for them to suddenly adapt for the younger generation might require like a change that many large organizations have tried unsuccessfully in the past to do.
Regardless of how they choose to invest, experts agree that the best thing young investors have on their side is time.
All or nothing is very enticing. It's very sexy, but a lot of people forget the nothing in all or nothing. Not advocating for people not to take risk, because risk is necessary in any form of investment. Without risk, there's no reward. And as young people, you should also learn to take on more risk. But understand that you have time to do it. And as a young person, time is your best asset, and it's the asset that only you have. Yeah.
Ultimately, compounding interest is critically important to your long-term success. And the sooner you can let that interest compound with a strategy that you can stick to, an irrational strategy that actually makes sense, you can have a great investment experience, 10, 20, 30, 40, 70, 80 years is how long I want to, if I live to 100, I would be an 80-year investor. And that's totally possible, totally likely, given the world we live in today.
What's this ETF called?
And as for financial advice on social media,
all of these different things inside.
I take that with a pinch of salt. I think it's quite interesting. It's quite entertaining, but more often than not, I would not prefer to get my advice from there.